Welcome to Copilot Podcasts. Imagine the stock market never closes. No bell at 4 p.m., no weekend reset, no moment where you're forced to step away and breathe. That sounds like freedom, right? More opportunity, more control. But what if that nonstop access is actually the most dangerous thing that could happen to most traders? Today, we're digging into the hypothetical but very plausible world of a 24/5 options market, what it would do to your psychology, your sleep, and your wallet. By the end of this episode, you'll understand why extended access isn't a level playing field, who actually benefits, and what the research already tells us about the hidden costs of trading without limits. Joining me is someone who's gone deep on the behavioral and economic side of all this. Let's get into it. So, paint me a picture. What even is options trading, and why does it already mess with people's heads before we even add the 24/5 element?
So options are financial instruments that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specific date. That distinction, right versus obligation, is actually where a lot of the psychological complexity starts.
Right versus obligation. Okay, so you're paying for a possibility, not a guarantee.
Exactly. And that framing already creates a kind of psychological trap, because the buyer's maximum loss is the full premium paid, but under extreme market conditions, the seller's potential loss can far exceed the initial income received. So the risk profile is wildly asymmetric depending on which side of the trade you're on.
Wait, so you could be on the wrong side of a trade and lose way more than you ever expected to?
Much more. And there's another layer that beginners almost always miss: time decay, which traders call theta. An option's value has two components: intrinsic value and time value. As expiration approaches, that time value continuously erodes. So even if the market moves in your favor, the erosion of time value can offset your gains entirely. Longbridge Academy describes it as the classic right direction, wrong outcome scenario, and it's very common.
That's kind of brutal. You can be right about the direction and still lose money.
It is brutal. And that's before we even talk about the emotional side. The fast-paced nature of options trading means traders have to be constantly vigilant, reacting quickly to changing conditions. According to Replete Equities, that constant pressure to monitor and make decisions is mentally exhausting and increases the risk of poor decisions driven by fatigue or emotional involvement.
So the market as it exists today, with defined hours, already pushes people to their psychological limits.
Exactly. And the popularity has exploded. The proliferation of online trading platforms and increasingly accessible education resources have drawn in millions of retail traders who are attracted to the potential for high returns and the ability to speculate on a wide range of assets: stocks, indices, currencies, commodities.
It's almost like the market has become this cultural phenomenon. Like, options trading has its own Reddit communities, its own TikTok influencers, its own mythology of overnight millionaires.
And that mythology is part of the problem. The allure of high potential profits in a short period of time is tempting, and it leads traders to take on risky positions or deviate from their trading plan. At the same time, the fear of losing money or missing out on potential profits creates this constant stress loop.
Fear and greed, the two oldest forces in finance.
And they don't operate in isolation. Insider Finance's Guide to Options Trading Psychology lays out how fear can cause traders to exit positions prematurely, missing out on potential gains, while greed pushes them to take excessive risks, hoping for larger profits. These aren't character flaws, they're predictable cognitive responses to high-stakes, fast-moving environments.
So now imagine you take that environment and you remove the closing bell. You make it 24/5. What changes?
Everything gets amplified. The behavioral biases that already hurt retail traders, overconfidence, confirmation bias, loss aversion, now have no natural circuit breaker. The market closing at 4 p.m. is actually a forced pause. It's the one moment where you have to stop, step away, and potentially recalibrate.
It's like removing the clocks from a casino. You lose track of time, you lose track of yourself.
That's a really apt analogy. And the research on problematic trading actually supports that framing. A 2025 systematic review published in Frontiers in Psychiatry by researchers from the University of Florence and Sapienza University of Rome found that the psychological literature has increasingly been treating problematic trading through a behavioral addiction framework.
Wait, behavioral addiction? Like trading as an addiction?
That's exactly what the research is wrestling with. The review found that 10 to 12 papers used the behavioral addiction framework, usually assimilating problematic trading to gambling disorder. But here's the nuance: only 4 papers conceptualized it as a distinct diagnosis from gambling. The researchers actually argue that problematic trading should be studied as its own phenomenon, not just a subset of gambling.
So it might be its own category of disorder entirely.
Potentially. And that distinction matters because the triggers, the feedback loops, the social context, they're different from gambling. With trading, there's a veneer of rationality, of skill, of analysis. That makes it harder to recognize when it's become compulsive.
Because you can always tell yourself you're doing research, you're being strategic.
Exactly. And a 24 for 5 market would make that rationalization so much easier. There's always another trade to analyze, always another position to consider. The off switch disappears.
Okay, so let's talk about sleep, because I feel like this is where things get really concrete and kind of alarming.
This is where the data gets genuinely striking. There's a 2025 MBR working paper, Trading in Twilight, Sleep, Mental Alertness, and Stock Market Trading, by researchers Han, Hirschleifer, Sheng, and Sun. They tested whether mental alertness, as proxied by sleep disruption, actually impairs investor trading performance.
And what did they find?
They found that retail investors who experience a later sunset time, which disrupts sleep patterns, earn lower abnormal returns on their trades. And the magnitude is large. Simply being on the later sunset side of a time zone border leads to stock investment decisions that generate 2 basis points lower daily abnormal returns, which compounds to about 5% annually.
5% annually just from being on the wrong side of a time zone border. That's not a rounding error.
Not at all. And the earlier version of that research from UC Irvine also found a 4.5% increase in the probability of asymmetric preference risk among sleep-deprived investors, meaning they start making lopsided bets, taking on more downside than upside without realizing it.
So sleep deprivation doesn't just make you slower, it actually changes the kinds of risks you're willing to take.
Right. The researchers suggest the mechanism is impaired attention. When you're sleep-deprived, you're less attentive to new information, which in options trading is catastrophic because the market is constantly generating new signals that you need to process accurately.
And a 24/5 market would be a sleep disruption machine for retail traders. Like if the market's open at 2 a.m. and you have a position, you're checking your phone.
Absolutely. And the CDC has already declared insufficient sleep a public health problem. More than a third of American adults aren't getting enough sleep regularly. Now imagine layering a market that never closes on top of that existing deficit.
It's compounding a problem that already exists.
And here's where it connects directly to the wealth outcomes question. Because the people most likely to be checking the market at 2 a.m. are retail traders, individual investors who don't have teams, don't have algorithmic systems, don't have the infrastructure to manage positions around the clock without personal involvement.
Whereas institutional players, the hedge funds, the prop trading firms, they have systems running 24/5 already. They don't need to sleep because their algorithms don't.
Exactly. And that brings us to the profitability data, which is honestly the most sobering part of this whole conversation. According to a February 2026 analysis by Lambda Finance, citing a SEBI study from India, which is one of the most data-rich regulatory environments for retail derivatives trading, about 91% of retail futures and options participants lost money in a full fiscal year.
91%.
91%. Only about 9% were profitable. And Lambda Finance also cites London Business School data and a CFA Institute blog suggesting that globally more than 90% of retail options traders lose money over time. This isn't a fringe outcome, it's the norm.
So the baseline, even with current market hours, is that the overwhelming majority of retail traders are losing. And you're saying a 24/5 market would make that worse. The structural forces all point in that direction. Lambda Finance notes that firms with advanced strategies, algorithmic systems, and risk teams account for a disproportionate share of gains. Individual traders often lack the tools, experience, or risk discipline to compete.
Extending hours doesn't change that dynamic, it amplifies it.
It's like opening a poker table for 20 more hours a day and calling it democratization, when the professional players are just going to win more hands.
That's a really clean way to put it. And the behavioral biases make it worse.
Longbridge Academy's analysis of options trading psychology identifies overconfidence, confirmation bias, and loss aversion as the 3 major cognitive traps. Overconfidence leads traders to underestimate risk. Confirmation bias leads them to seek out information that validates their existing positions. And loss aversion leads them to hold losing trades too long, hoping for a reversal. And all 3 of those get worse when you're tired.
All three get worse when you're tired, when you're stressed, when you've been staring at a screen for hours. The MBRE research specifically links sleep disruption to impaired attention, and attention is the foundation of every one of those cognitive processes.
I want to push back on something, though. Couldn't you argue that a 24 for 5 market gives skilled traders more opportunity too? Like, it's not purely a negative.
That's a fair point, and it's true that skilled traders with disciplined systems could find more opportunities. But the key word is disciplined. Insider Finance's guide emphasizes that emotional discipline, having a well-defined risk management strategy and sticking to it, is the cornerstone of successful trading. And discipline erodes with fatigue, with constant availability, with the psychological pressure of a market that never stops.
So even skilled traders aren't immune to the psychological toll.
No one is fully immune, but the gap between skilled and unskilled widens because skilled traders are more likely to have systems in place, stop-loss orders, profit-taking rules, defined risk parameters. Research cited by Insider Finance suggests that traders who set stop-loss orders and adhere to them are less likely to make emotionally driven decisions. The unskilled trader doesn't have those guardrails.
So the guardrails matter more than the hours.
The guardrails are everything, and a 24 for 5 market would test those guardrails constantly. Because the psychological challenge of options trading, as Replete Equities describes it, is the allure of high potential profits combined with the fear of loss. That combination doesn't rest. It doesn't take weekends off.
There's something almost philosophical about that. The market as a psychological stress test that runs indefinitely.
And the research on problematic trading from Frontiers in Psychiatry makes a point that I think is really important here. They recommend that future studies analyze problematic trading as a distinct phenomenon and avoid just mapping it onto gambling. Because the social legitimacy of trading, the sense that you're doing something analytical and rational, makes it harder to recognize when it's become harmful.
Right, because gambling has a stigma, trading has a LinkedIn profile.
Exactly. And that social legitimacy is part of what makes a 24/5 market so potentially dangerous for vulnerable traders. It's not just access, it's access wrapped in the language of financial empowerment.
Let's talk about the wealth outcomes piece more specifically, because I think the 91% figure is striking, but I want to understand the mechanism. Why does more access deepen the gap rather than close it?
The mechanism is really about information processing and decision quality under stress. Options pricing itself is already complex. The total price of an option is the aggregation of intrinsic value and extrinsic value, which includes time value and implied volatility. Skilled traders understand how these components interact. Inexperienced traders often don't.
And when you're sleep deprived and emotionally activated, your ability to process that complexity drops.
Drops significantly. The MBRE study found that the sleep disruption effect derives specifically from impaired investor attention. And in options trading, attention is what separates a good trade from a catastrophic one. You need to be tracking multiple variables simultaneously: the underlying asset, time decay, implied volatility, your own risk exposure. Meanwhile, the institutional player has an algorithm doing all of that without sleeping, without getting emotional, without checking Twitter at 3 a.m.
And that's the asymmetry that a 24/5 market would entrench.
Lambda Finance's analysis is clear that firms with advanced strategies and algorithmic systems account for a disproportionate share of gains. More hours means more opportunities for those systems to extract value from less informed, less disciplined retail participants.
It's a transfer mechanism disguised as democratization.
That's a strong way to put it, but the data supports the concern. When 91% of retail participants are already losing money in a regulated, time-limited market, extending those hours without addressing the underlying skill and behavioral gaps doesn't help the 91%. It helps the 9%, and especially the institutional players who sit above even that 9%.
So the people who are already winning get more time to win, and the people who are already losing get more time to lose.
And more psychological pressure while they're doing it. Because the constant availability of the market creates what Replete Equities calls the pressure to constantly monitor and make decisions. That pressure is mentally exhausting even in a normal trading day. Multiply it across 24 hours and you're looking at a fundamentally different psychological burden.
I keep coming back to the sleep research because it feels like the most concrete evidence we have. Like, it's not hypothetical. We already know sleep deprivation hurts trading performance in measurable ways.
And the MBRE researchers used 4 complementary approaches to establish causality: panel regression with household fixed effects, regression discontinuity design based on time zone borders, comparison of different seasons and latitudes, and daylight saving changes. This isn't a correlation. They established a causal link between sleep disruption and worse trading outcomes.
4 different methodologies, all pointing the same direction.
Which is about as robust as social science research gets. And the policy implication the researchers draw is that prioritizing adequate sleep for financial decision makers matters economically, not just for health reasons. That's a remarkable conclusion. Sleep is a financial variable.
Sleep is a financial variable. That's going to stick with me. So when you step back from all of this, the behavioral biases, the addiction risk, the sleep data, the profitability gap, what does it really come down to?
It comes down to the fact that a 24/5 options market would be a stress test that most retail traders are not equipped to pass. The psychological challenges of options trading are already significant. The fear, the greed, the cognitive biases, the exhaustion of constant monitoring. Those challenges don't disappear with more hours. They compound.
And the people who benefit are the ones who already have the infrastructure to handle it.
Exactly. Skilled traders with disciplined systems, stop-loss rules, profit-taking frameworks, they can potentially navigate extended hours. But even they face the sleep problem. The MBRE research doesn't exempt experienced traders from the effects of sleep disruption. Impaired attention affects everyone.
And the behavioral addiction angle is something I don't think gets enough attention in these conversations about market access. It really doesn't. The Frontiers in Psychiatry review from 2025 is significant because it's one of the first systematic attempts to take problematic trading seriously as a clinical phenomenon in its own right. The researchers found 23 papers meeting their eligibility criteria across 6 major scientific databases, and the conclusion is that we don't yet have a good enough framework for understanding when trading becomes compulsive. And a 24/5 market would be a real-world experiment in that question, with real people's money and mental health on the line.
Without the research infrastructure to even measure the harm as it's happening. That's the part that concerns me most. We'd be scaling up access before we understand the risks well enough to protect people from them.
Here's what this really comes down to, I think. The framing of 24/5 as democratization assumes that more access equals more opportunity for everyone. But the research tells a different story. Sleep deprivation costs retail traders up to 5% annually in abnormal returns, according to the NBRE study. 91% of retail derivatives participants are already losing money, per the SEBI data. And the psychological literature is only beginning to understand how compulsive trading operates as its own disorder.
And those 3 facts together paint a picture where extended market hours would most likely deepen the wealth gap between institutional and retail participants, increase the psychological burden on individual traders, and create conditions that are structurally favorable to compulsive behavior, all while being marketed as empowerment.
The actionable insight here isn't don't trade, it's understand what you're actually signing up for. Because the market, even in its current form, is already a psychologically demanding environment where the structural risks, time decay, leverage, behavioral biases are working against most retail participants most of the time.
And if a 24/5 market does become reality, the most protective thing a retail trader can do is treat sleep as a non-negotiable variable, build in the kind of rule-based discipline that insider finance and others describe, stop losses, profit targets, defined risk parameters, and be honest with themselves about whether their trading is driven by data or by emotion.
Data or emotion? That's the question that doesn't change regardless of what hours the market is open.
And the research is pretty clear that when you're sleep deprived, stressed, and constantly monitoring a volatile market, emotion wins, almost every time.
We started this episode with the idea that a market that never closes sounds like freedom. But what the research actually describes is a system where the removal of natural stopping points, the closing bell, the weekend, the forced pause, strips away the one structural protection that retail traders have against their own worst impulses.
The closing bell isn't just a tradition, it's a circuit breaker. And when you remove circuit breakers from a system under stress, you don't get more freedom, you get more volatility, and the people least equipped to handle volatility pay the highest price.
That's the line I'll be thinking about for a while. The closing bell as a circuit breaker. Thanks for walking through all of this. It's one of those topics where the more you dig, the more you realize the surface level conversation is missing almost everything that matters.
That's exactly right. And the fact that we're having this conversation hypothetically before a 24/5 options market exists is actually the right time to be asking these questions. because once it's live, the experiment has already started.
And with